Welcome to this last session for the day, Spotlight on Asia. In fact, we end the tour that certainly the sessions that I've been hosting have taken us around the globe over the past 2 days, and we're ending it in the region that is arguably the most important for this country. China, of course, is Australia's largest trading partner, so the rebalancing of the economy and the outlook for growth in that country couldn't be more important. But beyond China, there's also an absolute wealth of investment opportunities, but also, as we all know, it can be a minefield for the uninitiated. Where to put your money, how to put your money, who to talk to, who to ignore in such rapidly changing and incredibly diverse markets. Every single country has its own regulations, its own governance challenges, its own economic scene. So what makes a decision a good one, and why do some decisions succeed and others fail?
Hello. Hi, I'm Ali. I'm part of Siguler Guff. For those who are not familiar with Siguler Guff, we are a multi-strategy private equity manager globally. And we have been in the emerging markets since 2005. So I'm heading the China office, so the total AUM we're managing in China right now, it's all private equity, is about 1.7 billion US dollars. So today I'm just gonna give you an overview of the private equity industry in China, and hopefully it's gonna be helpful for people who are interested in China. So first, let's talk a little bit on the history of the private equity and the venture capital industry in China. The industry actually only started around the turn of the century, but I think in about 20 years' time, we have gone through a lot. Basically, it's from if you look at the picture, it's from the ape to the sapien. But overall, I think before 2010, that was the kind of the go-go years of the private equity in China. Basically, the GDP growth was very high, every year over 10% for more than 10 years. And the valuation arbitrage between the private markets versus public markets were significant. So what you do is you invest in a pre-IPO company, despite what the quality of the company is, and you get it, listed in the public markets, you easily get 10 times return, sometimes even 20x. But since 2010, things started to change quite significantly. So we are now seeing two worlds. One is the old world, the old economy, which is more affiliated with the fixed asset investment, such as heavy industries, property-related, heavy manufacturing, which are growing at, I would say, low single digit growth rate. But if you look at the new economy sectors, which are more affiliated with the technology, internet, mobile, and healthcare industries, it's growing at more than 20% a year. So it's really two-speed economy with two worlds. So that's why I think the private equity industry in China is becoming much more challenging than probably 10 years ago. So what's happening right now is that on the one hand, the return drivers have changed a lot over time. We have much lower GDP growth rate. High growth will only happen in a few selected sectors, as I mentioned. And the valuation arbitrage is actually also shrinking. But on the good side, consolidation is happening rapidly, which actually is improving the margins and the profitability of the companies. And also, you have the opportunity to pick and choose the next generation of GPs who are actually are more specialized in the few selected sectors mentioned just now. So good things, bad things, I think it's kind of a balanced world. And in terms of the exits, it's actually becoming more promising, more like the matured markets in the US or in Australia. So before, we were very much reliant on IPOs. Most of the exits for private equity are IPOs, but today we're seeing tremendous transaction volume on M&A and the trade sale. So now M&A and trade sale probably account for 1/3 of the exits for private equity. So going forward, our view is that the key success factors for private equity investments in China are the 5 things listed here. Really deep sector domain expertise, industry resources and operational capabilities to help the portfolio grow, investment discipline, because the markets tend to be quite volatile and the valuation can range quite a bit. Capital market savvy, to avoid extension risk, you have to, be smart about when you exit your portfolios instead of holding it forever. And the last but not least, interest alignment. So I want to emphasize the interest alignment point. I think it's probably not unfamiliar for you guys. The fund size, the fund size actually has a much kind of reverse, correlation with the return. And we are seeing that, in China as well. So our emphasis is very much on the younger generation, smaller fund GPs, which has done very well for us in China. So I think in summary, the gist of our secret recipe to be very successful in China is actually be able to stay ahead of the macro trends, and also not only the macro trends, but also the sector growth curve, basically to be ahead of everyone else in the, the potential, lucrative opportunities by seeking, or by investing the right GPs in the right sectors and at the right stage at the right time. So, that I think, in a nutshell, is the secret recipe. And of course, the manager selection is very key, as I mentioned just now. In terms of the government and regulatory environment, what I want to really emphasize on is that the government is actually doing, making tremendous efforts in promoting innovation, which is very conducive to the new economy sectors I just mentioned, such as technology-related and healthcare. So in terms of the R&D spending, China is catching up with the US very quickly. It's almost on a PPP terms, it's kind of the same already. And China actually promulgated 7 strategic emerging industries about 7 or 8 years ago, which includes technology, biotech, advanced equipment. But actually, the government is actually going even deeper down nowadays, putting a lot of emphasis on the really emerging subsectors within the technology, which are big data and AI, artificial intelligence. And not only that, I think apart from the technology, I think China really wants to also upgrade, the manufacturing capability as well. So there is a Made in China 2025 kind of a strategic plan, which requires the core components of all the, the manufactured goods in China to be having 70% domestic content. So at this point, I think right now we probably have 10 to 15%. A lot of the core components are actually imported from the developed markets. And also, in addition to that, the government is really also making a lot of efforts in reforming the country by through deregulation, more opening up of the restricted sectors to foreign investors, as well as the financial reform to allow more foreign investors actually into the financial market, including the capital markets, both equity and the bond. And from the individual consumer's perspective, you can clearly see that the major driver is actually, the income growth of the individual Chinese people. So this chart is very interesting. I show it every time to our LPs. Right now, I think if you look at the total population of the middle class and above, I think we are anywhere between 250 to 300 million people, which is almost the entire population of the US. The middle class definition here is $15,000 US per year annual income and above. So it's not exactly the, the threshold here, but it's a meaningful threshold, especially when you put in the kind of the PP, the perspective that how much money how many things that the money can buy in China. So I think the 250 and 300 million number is going to go to around 400 million by 2020. And the incremental consumption calculated by some consultants like BCG is projected to expand by another, 2.3 billion US dollars, which is equivalent to 1.3 times of today's Germany or the United Kingdom's total consumption. So in absolute terms, it's definitely a huge opportunity. And if you look at the sectors, as I mentioned, right, TMT broadly and also healthcare sectors are really the driving engines of the growth. There's just some numbers that are interesting. So if you look at the annual healthcare expenditure in China, right now I think we are around 4 trillion RMB. And here it says 6 by 2020, but I think the government recently has raised the target, so it's going to be 8 trillion by 2020, which means more than 15%, year-on-year growth in the next five years. And if you look at the e-commerce, it's growing. It's going to grow at above 20%, around 20%. After about 8 to 10 years of growth, I think in the 40 to 50% range. So it is still growing quite strong for e-commerce. And the media and entertainment, that's also becoming a big part of people's lives. And we predict, the online, the cinema and the online video spending in China is going to reach around 10 billion US dollars by 2019. And if you look at some of the technology subsectors, it's even more interesting. So in terms of the volume, transaction volumes, we are surpassing the US in a number of aspects. So if you look at the online payment transactions per day, in China we have about 500 million transactions per day, and I think it's still growing at a pretty rapid rate, versus the 20 million, for companies like PayPal. And if you look at the food delivery orders and also the ride-sharing rides per day, we are in the 20 million rides per day range, where if you look at the US, it's probably several million at most. And the online retail market share is also quite amazing. So right now, I think the total e-commerce transaction value in China is around 15% of the total retail transaction value in China, compared to probably less than 10%, like 7-8% in the US. And we are still growing at a very fast rate. And if you look at the healthcare industry, it's even more interesting. I think on the one hand, you are seeing surging demand because of the aging population and the increasing prevalence of cancers and the chronic diseases. And also in terms of the purchasing power is also increasing because government is extending medical coverage, the social Medicare benefits to 100% of the total population, and also the disposable income is increasing, and the people are increasingly more willing to spend money for their health. But on the supply side, we are in a very dismal state. So most of the products, the medical products like drugs or devices, are still of quite low quality, made by pretty low quality, Chinese manufacturers, pharma companies. So some statistics may be interesting to you. So look at the top, half of this slide. If you look at the number of the public listed health companies and also the market caps, for China is anywhere between 1/10 and 1/20 of that of the US. But we are the world's second largest economy. So it's really kind of, lagging behind for China. And but I think the good thing now is that more and more overseas Chinese are coming back to China to start up their own companies to make similar quality type of good products for the Chinese population, and the government is really supporting these type of startups. So anyway, it's a kind of an import substitution play for both drugs and medical devices with relatively lower technology risk. So we find that the healthcare sector is extremely attractive in China going forward. It probably will repeat the TMT story because the TMT side for China is already equivalently, as big as the U.S. I think healthcare has a lot to catch up, but I think we want to be in the kind of the China's Merck or Genentech or Amgen early on to reap the future benefits. So talking about the corporate governance, I think is something probably very important to Australian investors. More often than not, I think if you look at the privately owned companies in China, there is significant ownership of the largest shareholder, usually the founder, usually the first generation entrepreneur. And they have absolutely, super majority control over the company. And, sometimes the board supervision is not very sufficient. I think right now, the government has strengthened the corporate laws quite significantly. And I think the private equity investors have a natural advantage of, having a better and a more balanced ownership, therefore, better kind of a board supervision over privately owned companies. And also, I think in addition to that, I think the government is also doing reforms in the right direction, especially on the capital markets. So there is a very interesting thing is that for China, the IPOs used to be very much like approval-based. So the government actually needs to approve a company to go public. But I think now it's a almost de facto registry system, again modeled after the US market. So the government really wants to let the market decide, whether the company is good or not. Let the investors to make the votes instead of the government trying to judge for the investors. So that is really allowing for like real price discovery, right, in the capital markets for individual companies. And I think government is also increasing and strengthening the penalty for any fraud or any fraudulent behaviors in the public markets. So at the end, I think I was asked to give 3 pieces of advice for PE/VC investing in China. These are the 3 pieces of advice. I think first, you need to be very local. That means I think I don't recommend people to do China investments across the ocean in their home base. I think the recommendation is either you have a China office or you partner with a reputable partner in China who has done this for a long time. Second is you really have to take a very nuanced approach. Never ever take things at face value. You have to really look deeper down and peel the onion. And sometimes people tell you that it's something very much like the US or the Western world, but sometimes it has some very specific China element to it. But you have to know what are the really critical factors that will really affect the outcome of the investments, which you will only know if you have deep expertise and the knowledge of the market. And the third advice is actually act fast. Good opportunities in China, especially great opportunities, don't wait for people. Everything happens very fast in China. And there are lots of smart people, hunting around. So acting fast is definitely very important. But I think the prerequisite is that you have to know the market well. Again, you have to be prepared. Otherwise, acting fast will do more harm than good for you. Okay, I think that's my presentation, and I hope it's helpful.
Ali, can I ask you a question?
Yeah,
yep.
Sure.
Just before we move on, I'd just like to ask Ali one question, because you were very keen there to say that the regulatory environment is more conducive to investment now, and you also made the point that you need to understand the critical factors before you invest. I just wanted to ask how predictable China is in 2017 and the extent to which you can forecast where and when the government might move. And I'm thinking very specifically, and we've talked about this before, but back to last year when the government very suddenly changed or really announced tough new cross-border e-commerce laws, and we saw a major sell-off in China-focused consumer stocks when that actually happened. So and I know that they've since backtracked, but how predictable is it where the government's going to target?
Yeah, I think actually it's not that predictable, to be honest. The thing happened last year was, I think, more temporary than anything else. The fear sort of was a short-term fear, and then afterwards, actually, the government corrected itself, and it again, announced that, okay, the kind of the cross-border e-commerce is not really a big-scale smuggling. It's actually very much, personal in its kind of, the characteristics. So I think most of the kind of the cross-border e-commerce actually recovered. So there's not really, a deep blow on the business itself. But I think that overall the direction for the government is definitely to be more opened up instead of closing it, because I think again the wheels of the history will always keep rolling on, and you cannot come back. And I think even though there's sometimes some hiccup, you do some back and forth, but I think overall the big direction is definitely going more open and more transparent. And I think the government more and more realize that they need to be held accountable for a lot of things that they change in China.
Ali, thank you very much. If I can ask Rana to take the podium.
But before I start, because I think IFC, International Finance Corporation, we're part of the World Bank Group. We're a bit of a unique institution, and I'm just curious if I can just ask for a show of hands. How many here are actually familiar with IFC and what we do? Okay, so a few, not too many. Michael, you didn't raise your hand. You work at IFC, but you should. So IFC is part of the World Bank Group. As you can see here, we've been around for 60 years. And we invest in emerging markets globally, but on a fully commercial basis, no government guarantees, and we're really established to help promote the private sector in emerging markets, with the idea being that a vibrant and operating and successful private sector is really how you reach sustainable development. Without it, you won't have long-lasting sustainable development. And before I go to the next slide, I'll just leave you with I'll tell you a small anecdote, piece of information, interesting piece of information about IFC. So, it was actually an IFC investment officer who created the term emerging markets. The story goes as follows. I think maybe in the 1970s, 80s, I'm not sure when, an investment officer called a large company, a sponsor, saying, would you like to invest in developing country? Or he may have even said third world. The reception, not so good. Okay, went back, and of course our mandate is to promote investments in developing markets. Went back and approached another similar profile of investor, saying, would you like to invest in emerging markets? Reception was completely different, and hence the term emerging markets was coined. So I'll leave you with that. We're global. Just at a glance, just to kind of give you a sense, so we are an evergreen investor. So we have an initial capital of $2.5 billion, which was in 1956. We have not had any other capital increases or capital raises since. We've just reinvested our own money into our own profits. And our current balance sheet is about $90 billion. On the equity side, and I'm sure you'll be interested to hear how we have done, because it'll, kind of dovetail into how we look at Asia and why we think Asia is an interesting place to invest. Over 1,000 equity investments since 2000, close to $19 billion. With a 17% IRR. Now, if we look at Asia, I'm just curious here, how many would assume that our equity investments of Asia have done better than our global investments? Just a show of hands. Yes, no? Thank you, yes. So our return in Asia, we've done 399 investments, about 6.2 billion, with a realized return of 26%. So actually not too bad. And hopefully that sort of piqued your interest into why, looking at Asia might be an interesting opportunity. We do provide investment advice, and one thing that I would like to highlight is that we have, in 2005, established a wholly owned subsidiary called the Asset Management Company, and the reason that I think it's interesting to note is that we found that many investors were quite interested in having exposure in emerging markets, but were not fully comfortable in doing so on their own. And so by setting up this asset management company in a fund-like structure, we've mobilized capital that now invests alongside IFC into emerging markets, and sort of tried to hopefully open sort of the universe for investors who may not be completely comfortable in having emerging market exposure. We focus a lot on infrastructure, which is very relevant across Asia, agribusiness, financial inclusion. We do operate globally, and we're quite focused on sustainable investing and climate mitigating investment. And so on this thing of sustainable investing, one other thing that I would like to share is that I'm sure you have heard of a lot of financial institutions who then comply, when they do invest, they comply with what they call the Equator Principles. There are about 80 banks globally now that have adopted these Equator Principles, and these Equator Principles are modeled after IFC's, what we call our ESG performance standards. So, there's a few core things that we look at when we invest, and I think as a long-term investor, sort of sustainability and mobilization, I think, are key, and we found that they don't have to be mutually exclusive with good returns. So that kind of gives you sort of a background in terms of who we are and how we invest, and then I will now talk a little bit about sort of what we see happening across Asia. So I think, there's a lot of things that are happening across Asia, and I would say there's a number of, large forces that are shaping Asia's economic landscape. A lot of dynamics happening, but if I could put them into sort of these four key pillars. By 2050, as the first block says, 4 of the 5 largest economies will be in Asia. So there is an economic shift that's happening towards Asia. These will be China, India, Indonesia, and Japan. The 5th would be the US. So very important, I think, sort of economic transition to, growth and just general GDP heavyweights in the Asian market. The second, I think, will be the impact on sustainability. And what do I mean by sustainability? I mean that issues of climate change, population growth, urbanization will put pressure on water resources, energy resources, and agribusiness. And what does that mean? That means there will be more infrastructure that will be needed, better and more efficient agri-processing that will be needed. The third is the demographics. And my next slide will give another sort of perspective on the demographics. But one thing that's undeniable, and what is happening now across Asia, is now increasingly the population is aging, right? So 65 years old and above, that age bracket is increasing across Asia. And what does that mean? That means that will put pressure and needs for issues of healthcare, so as Ali mentioned, as well as infrastructure and probably technology as well. And lastly, what we call disruptive technology. I think it's undeniable, and I saw the people leaving the session prior to this, which was on technology, and it was a pretty full house. I think everybody's watching what's going to be happening in the technology space, because it's undeniable it's going to be changing sort of how economies are run, how production is made, how consumption is done, and how people interact. And I think Asia we are seeing an immense surgence in technology adoption, and possibly the move towards some more and increasing elements of disruptive technologies taking a role in the economic marketplace. Just for example, right now, about 52% of China's population are internet users. India, about 35%, and Indonesia, 20%. And I actually heard a statistics that was not too long ago that was quite surprising to me. I wasn't aware of this, but apparently Indonesia has the highest number of Facebook users of any country. pretty surprising, huh? But I think it just kind of is an indication of what a powerful role technology is going to be playing across Asia. Oh, there's a missing slide. Okay, there's a missing slide. I'll talk about it verbally. Sorry, something's missing in there. So the next slide should have what are the key drivers of Asia's growth, right? So the last one was the forces shaping Asia's economic landscape. But then what is going to drive the growth going forward? And so therefore, when you look at what's going to drive the growth, then you start to hone in sort of what will be my investment strategy across Asia. Here, I'll list five key components. Again, I'll go back to demographics. Yes, there's an aging population, but also there's a large, I think the median age right now is 33. Compared to 43 in developed markets. That means you have a large population that you can put to productive use and can put to work. So as we look across Asia, from IFC's perspective, we say, okay, this young sort of productive population can create investment opportunities. There are a number of countries where we see that they are educated, English-speaking, productive, and innovative, and so we'll target those markets where we feel that they can leverage that sort of strong demographic base to leverage the use. The Philippines is one, for example, where we think that their demographics are quite favorable, given the sort of the young population that can be leveraged. The second, is the growing middle class, right? 66% of the middle class will be in Asia by 2030. So what does that mean? That means more demands on infrastructure. That means more demands on better healthcare, education, consumption as well. So that's, I think, the second there. Third is urbanization. Right? 53% of the population will be, 53% of the urban population by 2030. Right now it's 44%. 100,000 plus people are moving into Asian cities every single day. Right? And just as a point of reference, in 1950, 13% of the population in China lived in cities. 2012, that was 53%. And by next year, that's expected to go to 60%. What does that mean again? Demands on infrastructure, demands on technology, education, healthcare, all concentrated into an urban center. Right? The fourth are political and economic reforms. So as part of the World Bank Group, this is something we monitor very closely. We have a very sort of robust engagement with countries about political and economic reforms. Is it in the depth and the breadth that we would like to see? No. But do we see progress? Yes, definitely. And in some countries we see more progress than others, but I think we're seeing incremental steps in the right direction. And the last, regional integration. 34% is Asia's share of 2015 trade. And of course, I think a few years ago there were two big sort of global economic pillars that were being discussed, right? One was TPP, and the other was what they called OBOR, which is now called BRI, Belt and Road Initiative, right? So after the recent U.S. elections, TPP is pretty much dead, and what's left is Belt and Road, BRI, and there's not a shortage of conferences or meetings or seminars to discuss BRI, and it's all about regional integration. And what does that mean again? It means infrastructure, it means moving of goods and services, consumption, and I think it's real. So it really is talking about that trade corridor from Asia through China into Europe and down into Africa and the Middle East. Now I can go to this slide. Yes. So for us, as we looked, we say, okay, this is the economic landscape, this is what's driving the growth. What do we look at? How do we invest in Asia? And I would put them into 4 buckets: inclusion, green growth, capital market development, and cross-border. And I'll give you an example of each to kind of highlight how we look at it. So inclusion, we're talking about access to finance, access to infrastructure, agribusiness. One example, IFC invested in a company called Manila Water. This was a water concession. It was privatized in 1999-2000. The government was running the water concession, and they sold it off to private investors. At that time, non-revenue water was 63%. Okay, so fast forward to today, non-revenue water has dropped to 11%. An additional 3 million people have access to water. They've replaced 90% of the network and provide 24-hour service. Even better, and just as, actually maybe not even better, but just as good, IFC invested a series of debt and equity with the company. Our return on that investment, 27% IRR. So, you know, the other one we've done recently is, I have to apologize, I'll mention something in China, although I was asked to talk about Asia, not outside of China, but we've invested in Ant Financial, which is a sort of an internet-based financing to expend more lending to Chinese middle and small enterprises, as well as women-owned businesses. So these are some of the sort of inclusion that we look at in terms of our strategy. Green growth. We think, as I mentioned before, sustainability, climate is increasing in issue, and I think presents then interesting investment opportunities across Asia. So let me give you one example. You'll see there is a company called Azure Power. So IFC got in very early with a solar, a solar power producer in India, and as he grew, we put in a little bit more money. Recently, now our AMC's Global Infrastructure Fund co-invested along IFC. This individual then took Azure Power and listed it on the New York Stock Exchange. So I think green growth with a nice success story. Cross-border, you know, I think it's no surprise and everybody's aware of the amount of capital that's available in Asia. So what we also do is we work with partners, both investment partners and industry partners, to sort of take Asian expertise and capital and bring it to other markets. And one example there we have is Olam, which is an agribusiness company. We've supported them through both the debt and equity, their expansion in India and in sub-Saharan Africa. And the last example I'll present is a capital market solution. And that is, you'll see there's a company there called Summit. In that case, what we did was, again, we invested alongside, I think it's our Asia Fund or Infra Fund, I'm not entirely sure which one, into a Bangladeshi domestic company that's an energy producer. We put in about 175 million of equity into this company, and their intent will be then to at some point list on the Singapore Stock Exchange. So it's basically sort of identifying good partners and bringing them to markets where they can have sort of larger capital market solutions to enable them to expand. So that's kind of the key investment strategy that we have. I'll go quickly in my next few slides. So I thought that what I would do is highlight just 3 countries, just to kind of give you a flavor of how we look at them. Indonesia, since inception, IFC has put in about 7.7 billion in Indonesia. It's the world's 4th most populated country, 261 million people, GDP growth of about 5%. And again there, reoccurring theme, infrastructure, financial inclusions, job creation, and disruptive technology. Right? And so, of course, there are a lot of challenges there, but I think there's a significant amount of investment opportunities in the country as well. Philippines, again, you know, IFC has done actually quite well in the Philippines. We've put in, we've invested a fair amount of equity, had decent returns. We think as amongst all of the countries in Southeast Asia, that one seems to be the one that's the most developed in terms of being open to private sector investment. The infrastructure, again, is a priority area. They have a very robust PPP program that they are in the process of, tendering out. And I think, there's some of the challenges are rapidly rising household corporate debt. It is quite a liquid market, but I think we see opportunities in a number of different areas opening up for non-Filipino investors and potentially good equity opportunities there. It, again, focuses on the PPP program, and again, I had mentioned earlier the sort of the young, skilled labor force. The last one I want to present is Myanmar. Now, it may be a little too frontier for everybody here, but just as IFC has nearly reached $1 billion that we're doing in Myanmar. We consider this really the last sort of untapped frontier market in Asia with a lot of potential. Population of 53 million. We've invested in hotels, we've invested in energy, and so, and it's a place where we have a really, really strong engagement with the government on political and economic reforms. And I will conclude, I see 20 seconds ticking away here, so I'll conclude with my last slide, which would be the key takeaways. So, of course, as you enter into sort of newer territories, diversification is key, right? And so diversification allows you to capture the potential upside while minimizing your downside risk. So I'd say that's one. Two, power of good partnerships. If there's one thing that I have learned in my years of investing through IFC, is that a good partnership really underpins the good investments. I can't tell you how many times we've had a decent investment go bad, and if the partner is not good, the investment goes bad, but if the partner's good, we manage to salvage something. And so that, if you're going into these new markets, and I think Ali mentioned that, good partners is critical. And managing political risk. And I say this not just to manage it at the sort of macro level, but within each country, you'll see sub-segments of political risk. You'll find that, for example, in Indonesia, power sector reform and the legal and contractual framework around the power sector is probably much better structured than, say, for example, water. And so it'll vary from country to country. So I think I'm done. I have to wrap up. If there's a couple of things that I would like to, just a couple of thoughts I want to leave you with is one,
very quickly,
remember that IFC coined the term emerging markets. Sorry, I had to repeat that. And then, good partners, I think, really make or break your deal. So thank you.
Thank you, Rana. We only have a couple of minutes for questions, but Rana, I just want to quickly ask you, you talked there about the countries, you've mentioned some sectors as well, and the power of good partnerships, which you both speak about. But of course, before you go and make a good partnership, you have to decide where you want to go in terms of where in the region. How does an investor in Australia approach that incredibly difficult question? Because the Philippines is different to Indonesia, is different to Malaysia, is different to Myanmar, and there is no way that you can look at Asia as a singular entity.
So I think you have to, so if you're an investor, you would want to look at my suggestion and say, okay, what is there a subsector that might be, or an asset class that might be, you might feel more comfortable with, and from that it'll drive sort of where you would go. So, for example, let's say energy is of interest, or renewable, for example, interest. Then that might guide into which country you'd want to invest. There, we would say maybe not so much Indonesia. You may want to go to the Philippines, or you may want to go to India.
How do you assess from afar the regulatory risk and the different challenges that you're going to face in a country? What's the best way of doing that?
You need to partner with somebody. It's impossible for somebody to do that on their own. I mean, they're welcome to come talk to the World Bank and IFC. We have offices on the ground everywhere. I encourage, you don't have to invest with us. You don't have to, partner with us, but I do encourage you to talk to, because we have people on the ground there. And there are many institutions, legal consulting institutions, that can provide you at least with that first level of assessment of political risk. And from there, then you kind of say, okay, this is what I can take and this is what I can't take, and then you go into the next level of granularity.
Do we have a question from the floor, just in the few minutes that we've got? All right. Okay. We've only got about a minute, so if you could.
What are good methods for partner discovery?
Good methods for partner discovery. That's what you want to know. How do you find the right partner?
Okay, so let me, how do you find, it's not, I don't think there's a magic formula to finding the right partner. The way we do it is we have presence on the ground everywhere. And we have the partnership with the World Bank that gives us sort of an inside assessment on the local environment. We try as best we can to create a network. When we have questions, we outsource to third parties to do KYC checks.
So bottom line is really, you've just got to do your research and talk to as many people as you can. Ali, what's your perspective on that?
I think it probably means different things at different times. I think, again, in China before, people like us, we invest in funds, we do direct with our GP partners. I think before you just need to, a lot of work is actually from a fund administrative point of view. So guys like us, we really look at the governance of look at our governance, our internal policies, processes, and all that. But I think China has entered into the next phase. So right now, as I mentioned, right, when we evaluate our GPs, sector expertise is really key. So when you evaluate us, it's the same thing. We have to know the sectors that we are going to be focused on. So it's easier said than done, because you have to know it, and then you have to assess. Are these people really knowing what they're doing? So I think different times represent a different, I think, type of criteria.
It's a whole new challenge, isn't it? Not just where to put your money, but who to put it with, really. Please join me in thanking our guests very much, Ali and Zhang. Rana.